Again, welcome everyone. We are thrilled to have you joining us this evening. So let me start off with some introductions. I'm Donna Walker. I'm a practice development coach and a senior startup consultant, and I will be presenting our PowerPoint today. Along with me on this call is Lori Ritchie. She is also a practice development coach with Clarity. So today's presentation is on the P&L playbook and understanding the percentages. So let's start off by talking about one of the most important financial tools for your business. It's your P&L. So what is the P&L statement? It's a profit and loss statement, or the P&L. It's essentially a financial report that tracks your revenue, expenses, and profits over a specific period of time. Think of it as a scorecard that shows how well your business is performing financially. So, why does it matter? It helps you understand where your money is going, what's being spent on supplies, payroll, marketing, and other expenses. It allows you to identify trends. Are profits increasing or decreasing? Are expenses getting out of control? More importantly, it helps you make better business decisions, whether it's adjusting pricing, reducing cost, or investing in growth. If you don't track your P&L, you're flying blind when it comes to financial decisions. Knowing what percentages of revenue goes to different costs what helps you gauge whether your business is healthy or needs adjustments. Understanding your P&L isn't just for accountants. It's for anyone who wants to run a profitable, successful business. So before we get into the details, how many of you already review your P&L on a regular basis? You can put the hand signal or hand emoji up in the chat. Good, 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 good. Yes, yes, good. So, what is the first major piece of the P&L? Revenue. Revenue, the top line, the total income your practice generates before any expenses are deducted. If you're looking into improve your profitability, this is where it all begins. Breaking down revenue streams makes it a lot easier to see where your money is actually coming from. Your total revenue or income should be made up of multiple service categories. If it's not, then get the breakdown from your POS. So you should have things like aesthetic treatments, laser skin rejuvenation, skin tightening, body contouring, hair restoration, PRP and PRF, medically supervised weight loss, wellness services, surgery, um, and your retail sales. Each of these play a role in your overall financial success, but not all revenue is created equal. Some treatments have higher costs, while others, like retail, often have strong margins if managed well. Looking at the numbers and this breakdown allows us to analyze the income. Diversification matters. If one stream takes a hit, others can help balance out your earnings. High revenue equals high profit. Some treatments bring in a lot, but also cost a lot. It's all about managing profit margins. Retail is an easy win. If you're not maximizing product sales, you're leaving money on the table. Now, some of you may have additional revenue resources like packages, series sales, and treatment plans. While these are can be valuable, I prefer not to include them in the top line revenue right away. And here's why. One, if you're paying a productivity bonus or a bonus of any kind to your providers, they should reflect realized revenue. Some of you may receive deposits on surgery. Let's say Nicole purchases a package of radio frequency microneedling. Instead of recognizing that revenue immediately, I prefer to wait until the service is actually performed. So if Lori provides the treatment, she gets credit only when the service is rendered, not when the package was initially purchased. Why does this matter? So imagine Lori ups and decides to leave the practice before Nicole completes all of her sessions. If Lori has already been credited for the full package up front, we'd be rewarding revenue that hasn't yet been earned, and that creates an accounting nightmare. Private equity. Private equity firms look at outstanding liabilities. When PE firms or investors evaluate your practice, they want to understand your financial obligations. Any prepaid packages, gift certificates, or memberships represent unrealized revenue, meaning you owe these services to patients before officially counting the money is earned. So by keeping these separate from immediate revenue, you get a clearer financial picture and avoid inflating your numbers with income that still carries a service liability. So let's talk expenses, because revenue is great, but we all know profit is king. So we've covered revenue, but what really matters is what's left over after the expenses. So that's where cost of goods sold comes in. Generating revenue is just one step, but true financial success depends on controlling what you spend to provide services. Cost of goods is a critical number because it directly impacts profitability. The goal isn't just to make money, it's to keep more of it by managing cost wisely, sorry. So what are cost of goods? Cost of goods include direct costs associated with delivering a service or selling a product. This means products, supplies, consumables. The lower we keep this percentage without sacrificing quality, the more profitable the business becomes. Every service category has its own cost of goods. Just like revenue, different treatments have different cost structures. So some have high cost, like injectables or PRP, where materials are expensive. Others have lower cost, like laser skin rejuvenation. By breaking down cost of goods per service, we gain actionable insights into profitability, pricing, and efficiency. So why break down cost of goods this way? It reveals the true profit margins. You know, some services bring in high dollar amount, but also cost a lot to perform. Categorizing cost of goods per service shows which treatments are actually profitable and which ones are or eating into our margins. It guides pricing and service strategy. Once you see the cost of delivering each service, you can adjust pricing accordingly. Are certain treatments underpriced relative to the cost? Should you bundle high margin services with lower margin services? Can you reduce waste or improve efficiency to lower cost? If cost of goods is consistently too high, you're either underpricing services or overspending on supplies. It helps to identify cost-saving opportunities. A clear cost of goods breakdown helps pinpoint where expenses can be reduced without sacrificing quality. Are we overpaying for supplies? Are we wasting product? Are injectors using more filler than's necessary? Can we negotiate better pricing with vendors? Small savings per treatment add up to big profit increases over time. It's going to strengthen your business for growth and investment. If you ever plan to scale or sell your practice, investors and PE firms will dig in deep into your cost of goods. They're not just looking at revenue. They want to know how efficiently your business operates. A well-documented cost of goods breakdown makes your practice more attractive and financially valuable. A business with strong revenue plus optimized cost of goods equals a higher valuation and long-term sustainability. It shows where to focus marketing and sales efforts. Understanding cost of goods helps you allocate your marketing dollars more effectively. Services with a low cost of goods and a high margin, they're ideal for promotions and sales incentives. Services with high cost of goods and low margin, maybe we need to adjust the price. Maybe we need to adjust the pricing, or we need to come up with some cost reduction strategies. Retail sales, they're going to be high margin potential, meaning staff should be actively trained to sell. If a service is costing too much to perform, either adjusting the price or focusing marketing efforts on more profitable treatments. Breaking down cost of goods isn't just about tracking expenses, it's about understanding where your profit comes from, and how to keep more of it. By taking a deeper look at cost, we gain insights needed to increase profitability and improve pricing and optimize service efficiency. So we've covered revenue and cost of goods. Now let's talk cost of labor. Labor is one of the biggest expenses in any practice. Managing cost of labor is the key to profitability while ensuring that our staff are fairly compensated and motivated. Now, Lori and I had a community call discussing what labor cost entails, so you should watch that community call. We talked about the compensation, whether commission or hourly. We talked about all the things that it includes: bonuses, benefits, and taxes. All of these should be included in your labor cost. Understanding this cost of labor refers to provider payroll, the cost of paying your team to deliver services. Your target: keep provider labor less than 20%. Breaking it down by role, each provider type has a different compensation structure affecting overall cost of labor. Estheticians and laser techs sometimes have lower hourly rates, making their services highly profitable when priced correctly. Injectors, NPs, PAs, or RNs bring in high revenue, but their higher pay requires labor management. MDs and surgeons, they have more expensive labor, so pricing must account for their overhead. Cost of labor by services. Just like cost of goods, cost of labors vary by treatment. So tracking cost of labor per service helps guide pricing, staffing, and profitability strategies. Why does this matter? If cost of labor is too high, profitability suffers, even with strong revenue. So to manage it effectively, you must monitor provider productivity. Revenue per hour should justify payroll expenses. Balance compensation with pricing. If labor is expensive, pricing must reflect its value. Optimize scheduling, reduce downtime, maximize appointments, efficiency, and improve labor ROI. Labor is one of the biggest costs, but it's also the backbone of your business. So keeping your cost of labor at 20% or less revenue ensures sustainability and financially sound practice. So now we're going to talk about the sneaky expenses: credit card fees and third-party financing. These costs may seem small, but they add up fast and can take a serious bite out of your profits if not managed properly. Credit card fees, this is the silent profit killer. Every time a client swipes their card, a portion of the payment goes to the processing company. Typically, credit card fees will run 2 to 4% per transaction. We don't want them to be any higher than 3%. So if your practice is processing $1 million in credit card payments, that's $20,000 to $40,000 lost in fees, money that should be reinvested in your business. So, ways that you can reduce credit card fees, negotiate with your processor. High volume businesses may qualify for lower rates. Encourage debt or ACH payments. These debit or ACH payments. These payments can often come with lower fees. Consider a small processing fee for credit cards. Some businesses pass on a portion of the fee to the customer. Third party financing. The cost of convenience. Services like Care Credit and Cherry may make high ticket treatments more accessible, but they charge 5 to 15% per transaction, and this is a major expense. So, when does financing make sense? High ticket treatments, financing makes expensive services more attainable. Low cash flow clients expands your client base by making treatments more affordable for those clients. Marketing strategy, promote it. Make sure that people know what options they have for financing. Credit card and financing fees are the cost of doing business, but they shouldn't erode your profits. So track these fees with the credit card companies, look at statements, look at them each month because credit cards will creep up on you. Adjust the pricing if necessary and explore payment strategies to keep more revenue in your pocket. So, overall, gross profit is the real measure of business performance. Now that we've covered revenue and cost of sales, let's focus on the number that truly tells us how well our business is doing: gross profit. This is the money left after we subtract the direct cost of delivering the service. So, what is gross profit? It's revenue minus the cost of sales. This tells us how efficiently we're operating and whether we're actually making money on our services. Breaking down the cost of sales, there are three major categories: cost of goods sold, which our target is going to be 30% or less; cost of labor, our target is going to be 20% or less; and merchant fees. And we know that they can add up quickly. So, why does gross profit matter? It covers overhead. The higher the gross profit, the more we have to pay for rent, marketing, administrative salaries, and other expenses. 50% is going to be our target or more. A strong gross profit should be 50% or higher to sustain a healthy practice. Revenue equals profit. High revenue doesn't guarantee profitability. Managing cost is just as important. And it helps with early problem detection. Regularly reviewing gross profit helps cash flow issues before they become a big problem. So now that we've covered revenue, cost of goods sold, and labor expenses, let's move to another critical part of the P&L, your operating expenses. These are the costs that keep the business running, things like rent, marketing, software, insurance, and administrative salaries. Unlike cost of goods and labor, which are tied directly to the service delivery, operating expenses exist whether you're seeing patients or not. The key to profitability, a profitable practice, isn't just increasing revenue, it's making sure your operating expenses are well managed. So property operations, it's a is a necessary expense, but a manageable one. One of the unavoidable costs of running a practice is your property operations. These are facility expenses. They may not be as exciting as revenue and profit, but they directly impact your financial health. The key is ensuring that these costs stay in check so they don't take up too much of your budget. Facility fees can include things like rent and taxes. This is the lease or mortgage payments plus any property taxes. CAM is common area maintenance fees, your shared building costs like lobby or your parking or exterior upkeep, your real estate taxes. Maybe on some, it can be separate from your rent, depending on your lease terms. Utilities, electricity, water, and gas. Tracking fluctuations helps with budgeting. Maintenance, HVAC service can be a huge one. Plumbing repairs, general upkeep, laundry and cleaning supplies necessary for maintaining your medical grade sanitation, cleaning services, regular janitorial costs to keep the space professional and compliant. Facility expense can take up a large percentage of revenue, so keeping them controlled is crucial. Property costs are fixed, meaning they don't fluctuate with revenue. So the only way that you can get your facility fee percentage to go down is that revenue goes up. Negotiate rent and CAM fees whenever possible to keep expenses more manageable, and track utility and maintenance costs to identify potential savings and opportunities. So a well-maintained, welcoming space is essential, but it shouldn't compromise your profitability. Now let's talk about an expense that directly drives growth: marketing. Unlike fixed costs like rent, marketing is an investment. So when done right, it brings in new patients, it builds brand awareness, and it boosts your revenue. But it's also an area where spending can easily spiral out of control if it's not tracked properly. The key to ensuring that every dollar spent on marketing is delivering a strong ROI. So let's break down the most effective marketing expenses and how to optimize them. So there are many different components that come to the marketing strategy. So website and SEO. Your website is often the first impression potential clients have to your practice. So SEO ensures that they can find you when they're searching online. Advertising, this includes paid ads on Google, Facebook, Instagram, and even print or local sponsorships. Social media and content marketing, posting engaging content, showcasing results before and afters, and interacting with followers builds credibility and trust. Email and SMS marketing. This is a direct and cost-effective way to keep clients informed about promotions, new services, and appointment reminders. Public relations and branding, building brand awareness through media coverage, partnerships. Promotional materials and merchandise, branded items, brochures, and giveaways to keep your business top of mind for your clients. Referral and loyalty programs, encouraging word of mouth marketing by rewarding clients for bringing in new business. Networking and sponsorship, industry events, collaborations, and community sponsorships to increase exposure. Video production, high quality video content is a game changer. It's education and engagement. Marketing, your marketing team. Sometimes you're going to have a marketing manager. Maybe you're going to have a social media coordinator or a content creator or a videographer. Whether it's in-house or outsourced, having professionals handle marketing can make a huge difference. Maximizing marketing ROI. It's not just about spending the money, it's about making sure that every dollar works for you. So you're going to want to track performance. Knowing which channels bring in the most clients helps focus efforts where they matter. Prioritizing high ROI strategies, email marketing, referrals, organic social media engagement often provide the best returns. Adapting based on results, marketing trends. So continuously evaluating and refining the strategies is essential. Marketing isn't an expense, it's an investment in growth. The key to spending smartly is tracking what works and adjusting the strategies accordingly. Administrative labor. So let's shift to another essential part of the P&L. These are the behind the scenes costs that your business is running, that keeps your business running smoothly. So while administrative labor is necessary, they can quickly add up. So let's take a closer look at what's included and how to keep them in check. So administrative labor, it's the backbone of a well-run practice. These can help boost your revenue, and they are essential for keeping operations running smoothly and ensuring a great patient experience. So some of the roles are a manager and assistant manager, patient care coordinator, a front desk or receptionist, your IV lounge assistant or medical assistant. Um, so why does managing administrative labor matter? These roles are critical for practice success, but their costs must be carefully managed. Optimize workflows, ensure that staff time used is used efficiently and productively. Cross-training your staff, that's so important. Cross-training staff can help reduce payroll costs while maintaining a seamless operation. At the end of the day, administrative labor is about balance, having the right number of staff to support the practice without unnecessary overhead. General and administrative, G&A. These are indirect costs that support overall operations of the practice but don't directly generate revenue. They include things like insurance, legal fees, office supplies, software, and administrative salaries. While these expenses are necessary to run the business, they too need to be carefully monitored. So, insurance. It covers professional liability, business insurance, and workers' comp to protect the practice. Professional fees, legal and accounting and consultation services, bookkeeping and payroll services, the cost of the financial management, payroll, and HR support, permits and licensing, um, required regulatory costs to operate legally, decor and display, creating an inviting space to enhance the client's experience, dues and subscriptions, memberships for professional organizations and industry resources, and medical-like databases like Clarity and AmSpa. Donations, charitable contributions and community engagement initiatives, telephone, internet, music services, communication tools, Wi-Fi, and in-office ambiance. Medical director fees. This is compliancy. Office and operational costs, office supplies and postage, small expenses like printer and ink, paper, mailing fees that add up over time. Training, investing in continued education to keep your staff skilled and competitive. Uniforms, branded or professional attire to enhance the client experience. Meals and travel, business-related team meetings, networking, and professional development events. So while G&A expenses are necessary, they should be monitored and optimized to avoid unnecessary overhead. Keeping them under control allows for better reinvestment into revenue-generating areas of your business. So now that we've broken down the different expense categories, let's talk about one of the most important aspects of financial management. And I think it's the percentages. Percentages, tracking percentages, rather than just the dollar amounts, helps us to understand how different costs compare to total revenue. It allows us to see where we're on track and where we may be overspending. By knowing the right percentage benchmarks, we can set better goals, optimize spending, and ensure long-term profitability. So let's break this down in a simple way. So when we're looking at revenue, we want to see how much each service contributes to the total income. That's where the percentages comes in handy. And I'm going to share a worksheet with all of you in the chat box before this is over, where you will be able to utilize a worksheet to write down your percentages. So it's super easy to calculate. You're going to take the revenue from a specific service and divide it by the total revenue and multiply by 100. So for example, I did a little P&L example, and aesthetic services. They brought in $129,456.23. Our total revenue is $1,527,250.88. If we do the math, we get 8.48%. That means that aesthetic services is a little under 10% of our revenue. Now check out injectables. Injectables, this category is bringing in about 35.38%. So of our total revenue, that's huge. It tells us that injectables are a major revenue driver for the business, and we need to keep that in mind. However, if we want another category of service to come in higher, then we need to market that service. Retail is at 16.67%, which is actually really good because we really want retail to be at 20% of your service revenue. For every $100 of service, we want you to sell $20 worth of retail. So if we can boost retail sales even more through memberships, product recommendations, or bundling with treatments, we can increase our bottom line without adding more labor cost. Let's look at skin tightening. They're sitting in about 10.09. That can mean a couple of things. Maybe we need to market this service better. Are patients fully aware of the benefits of skin tightening? We need to come up with treatment plans to educate the client on the need for the service, making sure to couple the service together with other services for more exposure. At the end of the day, understanding these percentages helps us figure out where to double down on success and where we might not, where we might need to adjust our strategy. How do we calculate cost of goods percentages? Cost of goods is calculated by dividing the cost of goods for each service category by the service revenue of each category. So if I take laser skin rejuvenation, so the cost of goods for that is $12,468.76. The total revenue produced was $248,375.25. So the formula basically is that this is going to equal like 0.49 or 0.5%. So what this percentage tells me is that what these percentages tell me is that injectables are at 45% cost of goods. This generates a high revenue, but it has high cost. So we need to be strategic about the pricing. Maybe we upsell, maybe we sell more injectables and we get more, but we have more value in the selling injectables. Skin tightening, it's at 20%, but let's say it was at 25%. Then that would be too high. It's time to check this with our supplier pricing or adjust the cost. Body contouring sits at 10%. That's a great margin, making it a strong candidate to promote and growth, for promotions and growth. Tracking cost of goods percentages helps us decide which services to promote and how to price them and where to cut costs to maximize profitability. So let's talk about the key numbers to track to keep your practice profitable. Now remember that our goal is that your cost of labor should be 20% or less, and your cost of goods should be 30% or less. This is why our pricing strategy and service selections are critical to our profitability. So we must use revenue per hour to optimize our service mix. Our revenue per hour calculator, it helps measure profitability per treatment and guides service optimization. Um, let's look at a couple of examples. So for skin tightening, you want your revenue per hour to be $1,000 or more. So with a $200 in consumable cost, so it's going to be 20% or less. This is a great balance. Your injectables, you want it to be revenue per hour is going to be $1,000 per hour, with their cost of goods being 50% or less. So since the margins are tighter, pricing and volume strategy are key. Laser skin rejuvenation, it generates about $850 revenue per hour, and it's only 10% in consumables. So these are the benchmarks that we want you to go by. Your revenue per hour, it identifies which treatments yield the highest profit per hour. It highlights services that may need pricing adjustments and ensures your labor and supply costs align with revenue goals. You're making data-driven decisions because of these benchmarks. They aren't just random numbers. They're industry standards used by top performing practices. By tracking these key percentages, you can compare your practice's performance to the industry benchmarks. You can renegotiate your vendor pricing if costs are too high. You can adjust service offerings based on profit margins. And finally, you can track your numbers regularly. Don't guess when it comes to profitability. You can keep labor and supply costs under control. Small increases in inefficiency add up. Prioritize high margin treatments, adjusting pricing and service mix to maximize your profits. A few small changes in pricing, vendor negotiations, and service selection can make a huge impact to your bottom line. So when you're just starting out, rent can be a big part of your expenses. It's common for a new practice to spend about 15 to 20% of revenue on rent. That's because at the beginning, you may not be maximizing your service volume yet, but as your revenue grows, that percentage should come down a little bit. The goal is to increase efficiency, meaning that for every dollar earned, a smaller portion is going toward rent. For established practices, the sweet spot is keeping rent at 10% or lower as a percent of revenue. So why does this matter? If rent is too high, it eats into profitability and it makes it harder to invest in staff, equipment, and marketing. If you're paying 15% or more in rent long term, it might be time to evaluate your space. Are you fully utilizing every treatment room? Can you increase revenue per square foot with more high ticket services? Maximizing efficiency is key. If you can generate more revenue from the same space, that rent percentage naturally decreases. If you're above 15%, you're going to focus on the revenue growth to bring the percentages down. If you're above 20%, consider whether the space is too big for your current needs. The goal is 10% or lower for long-term sustainability. And as you can see in the example that I have here, it's $124,191.92 divided by the total income, which is $1,527,450.88. That puts it at about 8.13%, and that's quite good. Now remember where I talked about marketing. So marketing can either be a major expense or a powerful revenue driver. but the key is knowing where your money is going and what is it generating. No matter how great your services are, um, it doesn't matter how great your services are if people don't know about them and they can't book. So, how much should you spend on marketing? The general rule is you should allocate 5 to 10% of your total revenue toward marketing. If you're a practice that's in growth mode, you're a new practice, or you're competing with a competitive market, you should do about 10 to 12% to build awareness and attract new clients. Established practices, they can have 5% or less if they have strong referrals, the client retention is there, and the organic marketing strategies are there. So once again, you're just going to divide the marketing total by the total revenue. So 150K divided by 1,527K, it's about 0.9% or 9.82%. Now that's not bad, but are you tracking your ROI? Are your ads working? Marketing isn't just about spending, it's about results. So run ads for at least 3 months, then track it. Are they generating leads? Are the leads high quality? Good prospects versus wasted inquiries? Are they converting into booked treatments? If you're spending but not seeing results, adjust your strategy, optimize your targeting, or shift your budget to higher performing channels. Grassroots marketing, a cost effective alternative. Not all marketing has to be expensive. Grassroots efforts can be highly effective while keeping costs down. Networking, hosting community events, leveraging social proof, before and after photos, testimonials, and referrals. Marketing should be an investment, not an expense. It's if it's not bringing in the business, it's time to reassess. What percentage should your admin labor be? The goal is to ensure administrative labor supports the business efficiently without adding unnecessary overhead. So, total labor, admin plus productive labor should be 30% or less. Admin labor alone should be 10% or less of revenue. So, breaking down the calculation, to determine if admin labor costs are within the right range, we divide admin payroll by total income. So for my example, I've got $305,000. The total income is 1.5 million. So my percentage is at 19.91%. This is a big red flag. Admin is significantly higher than 10%. It might be an indication that there might be some inefficiencies in the staffing or role distribution. So, how do we optimize our labor costs? We cross-train staff. Don't forget, we can have staff doing multiple things. Ensure the front desk patient coordinators and admin teams are working efficiently. Leverage automation. Use scheduling, billing, and follow-up software to reduce manual tasks. Monitor payroll expenses. Regularly track wages, bonuses, and benefits to ensure admin costs remain in check. Evaluate role necessity. Are all admin roles necessary, or are certain tasks being streamlined? If your admin labor costs are creeping up, take a closer look at how roles are distributed. Explore automation. Ensure that administrative support is adding value to the business without cutting profitability. Regularly review these numbers and make adjustments. General and administrative. So these expenses are necessary for running your practice, but they need to stay within the right percentage to maintain profitability. So what should G&A expenses be? Your target should be anywhere from 15 to 25% of total revenue. 15% or lower is a highly efficient operations. 20 to 25 is normal for a well-managed practice, and above 25% could indicate inefficiencies and overspending. How are you going to manage your G&A expenses? You're going to regularly review the expenses, identify areas to cut costs without sacrificing efficiency, negotiate vendor contracts from insurance to bookkeeping. Always look for better rates. Automate administrative tasks, reduce manual work to save on labor costs, track percentages monthly. If G&A exceeds 25%, look for inefficiencies and adjust spending. G&A should support your business, not slow it down. Keeping it within 15 to 25% ensures financial stability and allows for reinvestment into high impact areas like marketing and staff training and new service offerings. If the cost creeps too high, it's time to evaluate where the money is going and make strategic adjustments. EBITDA. So this is the be all end all. It stands for earnings before interest, taxes, depreciation, and amortization. It helps measure the true operating profit of your business by stripping away the financial taxes, tax and non-cash accounting expenses. So it measures operating profitability, which focuses on how much money the business generates before financial and tax-related expenses. It focuses on core business performance. It helps determine if the business model is sustainable and profitable, and it's useful for investors and PE firms. The EBITDA is a key metric used in valuations of mergers and acquisitions. So why does EBITDA matter? It isolates operational performance. It allows for industry comparisons. It's important for potential buyers and investors. They want to know how much cash flow the business generates before financing and tax obligations. So how is EBITDA calculated? The percentage. So for this example, we have an EBITDA of $9,199. So divided by the total income of 1.5 million, that's less than 0.6%. That's not very good. So a strong EBITDA means the business is profitable at its core. We want it to be 20% or higher. But it's essential to manage expenses like interest and taxes to maintain a strong net income. So ideal EBITDA ranges by business type. If you're a med spa, typically we see 15 to 25%. If it's plastic surgery center, we typically see anywhere from 25 to 40% of revenue. So the final takeaways, we're going to turn insight into action. So let's recap. If nothing else, the big takeaway is that understanding your P&L and tracking key percentages isn't just about the numbers, it's about making better business decisions. Revenue is the starting point, but profitability is the goal. Cost of goods sold should stay at or below 30%. Labor costs should be maintained and carefully keeping total labor, admin plus productive at 30% or less. General and administrative expenses should stay at 15 to 25% to avoid overhead eating into profits. And marketing is an investment, not an expense. Track the ROI to ensure it's driving growth. The numbers don't lie. Your P&L is a tool, not just something to review at tax time. Successful practices track their percentages regularly and make small adjustments that add up to big results. The call to action, what you've learned, taking this worksheet and applying it to the practice, run your numbers, compare them to benchmarks, identify areas for improvement. If something looks off, don't ignore it. Adjust, refine, and optimize. One of the most effective ways to drive profitability in your practice is by getting your team involved. So one of the calls that we're going to do next month is talking about how to take the worksheet and what you've learned today and share it with your staff members. Because when your staff understands how the numbers work, especially with the percentages, that impacts them greatly. They can impact profitability. They can contribute to making smarter business decisions. So the more transparent you are with your team, the more engaged and motivated that they'll be. When they see how these efforts contribute to the financial success of your practice, they become partners in profitability, not just employees. And as always, we always have the support office hours for anybody who wants to jump on support office hours. They're Wednesdays at 5 p.m. Anybody who wants to jump on the practice development office hours, they're Tuesdays at 12 p.m. Eastern, 9 Pacific. And as always, all of our tech and educational courses are listed in the curriculum. So you can scan the QR code if you want to join any of these classes. And I'm going to put in the chat the worksheet.
That was wonderful, Donna. I'm not